Over the past year and a half or so, I've been waiting for cap rates to go up and prices on self-storage to start coming down. I'm still waiting. How about you? Let's talk about cap rates and when they may be changing in the self-storage sector. Hello, my name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Quick Start Academy. And what I do is I support the small investor who wants to get in the self-storage business or who wants to grow their self-storage business, strategically do so in a way that creates true wealth and a fulfilling career. And I love the self-storage business. For the small investor, it is absolutely the best real estate and business play I think that there is out there. But it's awful difficult to be buying existing self-storage today because cap rates are so low. Now, over the past year and a half, especially a year or so ago when interest rates were starting to fluctuate, I really expected to see cap rates start inching their way up. What I've seen is they haven't gone down much lower, but I sure haven't seen much of a rise in cap rates. What about you guys? What could change in the last half of 2019 or the upcoming year 2020? What would have to change that would affect cap rates for self-storage? Well, I think there may be a change coming, and let's talk about that. Let me just tell you what I'm seeing out there right now, and let's explore how that might influence cap rates. Well, interest rates. Let's talk about that. I don't see interest rates going up much in the next 6 months to year or year and a half. So I don't think there's going to be any change in the cap rates due to anything going on with interest rates. The Fed's probably not going to be raising them because if they feel there may be a downturn looming on the horizon, they're going to not be messing with the interest rates much at this point. But things are beginning to feel a little bit different out in the marketplace. Let's talk about the trade war. Now, as self-storage operators and owners and developers, we've directly experienced the effects of the trade wars that are a result from the person in the White House. You know, our self-storage costs for expanding or building have gone up anywhere from 20 to 40%, depending on when in the last year it's been and what part of the country we're in. It's had a definite effect on the storage industry, but for some reason, most of the rest of the markets have shrugged off the trade wars. That is until very recently. You've begun to see a lot of market volatility in the stock market, and a lot of that's due to what the nationalism investors see emerging in the economic policies from the U.S. as well as some other countries out there. What that does is it creates uncertainty. When the Federal Open Market Committee met in February, what they predicted was they saw that the GDP for the U.S. is going to go down in 2019 from the previous 3% all the way down to about 2.1% in 2019. And in 2020, it's predicted to go down to 2%. And they predicted as low as 1.8% in 2021. Now, this reduction, at least according to that non-political body, was due as a direct result of the trade wars. So I don't see, no matter what happens in the next year and a half, I don't see any election changing what's going to be happening to the GDP in the next year to year and a half. So what that, in my opinion, that effect is going to create a real sluggishness in the economy. In my commercial real estate business, we're already beginning to see companies moving to the sideline that we were working with expansions are now kind of standing on the sidelines waiting to see what happens with the economy over the next year to year and a half. I mean, I haven't heard conversations like that since 2008 through 2010. Now, I'm not equating this time to that time. I'm just saying those kind of conversations, it's been a long time since I've heard them, where people are just pulling on the sideline and waiting. The unemployment rate is still low. On the surface, it looks very good. But you don't have to look very deep to see that there's something else really going on with unemployment. There's been people who have been unemployed from high-paying jobs so long that they've taken part-time, low-income jobs and show up on the radar very often as gainfully employed. Over the next decade, jobs requiring a master's degree are going to be the ones growing the fastest, and jobs requiring just a high school diploma are going to be growing the slowest. So as our economy evolves, what's going to happen is we're going to need a much more highly educated labor force to keep the growth in the economy going. So how does that affect us in storage? Well, one of the things I've begun to look at is I'm looking at submarket. I not only look at the population growth, square feet per capita, and household income, but I'm also beginning to look at what is the education level of that market or submarket, because the higher educated submarkets or markets that are in tourist area where there's a lot of the economy is based on tourism, in my opinion, those are the markets that are going to have the population growth over the next decade or two. Now, it's not always easy to get those numbers, but you can get them. Now, what is all of this saying about cap rates and self-storage? Well, I'm not an economist. In fact, you probably shouldn't pay a whole lot of attention to what I say. But that doesn't stop me from making a prediction anyway. What I'm predicting is over the next 6 months, last half of 2019, the economy is going to begin to feel real sluggish, and nothing's going to change as we move into 2021. And what I think the effect that this sluggishness is going to have is that cap rates on properties that are in overbuilt Tier 1 markets and cap rates on properties that are in very rural areas will begin to have a slight increase in them, and sellers' expectations will start becoming a little more real. Properties for sale that are in very strong secondary markets, I don't think there'll be much of a change in the cap rates on those properties. Those are where the storage opportunities are, and most people recognize that today. The other effect that this sluggish economy is going to have is it is going to keep the lease-up rate sluggish itself and slower. Now, remember, according to the SSA, the average time of lease up to stabilization has gone from 30 months to 36 months. I don't see that going down anytime soon. In fact, if anything, it may increase a little bit. So the game is, don't be caught out there in 2021 with a property that's 10% leased or 20% leased, and you've got to get to 55 or 60 before profitability. But remember, as the economy slows down, self-storage is the asset class to be in. Self-storage, although not recession-proof, is recession-resistant, or at least it has been in the past. That's one of the reasons we're experiencing these low cap rates and high sale prices, is because of how well self-storage performed in the last recession. So the opportunities are out there. We've just got to be very careful and selective at how we go about getting in or growing our self-storage business. Now, the good news is that about 62% of all self-storage facilities are owned by someone who just owns one facility. And what drives those to the market very often has little to do with cap rates and what's going on in the economy. What drives those to the market are a change in the life of the owner. And very often they've gotten very complacent with their cash flow, and many of these deals are going to be hitting the market between now and the next decade. And in my opinion, for the small investor, that's where the opportunity for this is, because we can buy those mom and pop facilities, and the vast majority of them out there are just that, and then we can reposition them as a more institutional and well-run facility in today's self-storage climate and reap the rewards from it. So that's my prediction about cap rates. They will start to go up slowly on the Tier 1 cities that are overbuilt in the rural areas in the next year, year and a half, and they'll still stay relatively low on the strong tier secondary markets. Let's see if my predictions are right. My name is Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer, the financial analysis tool we use to make the cash flow predictions and projections for the opportunities that we're looking at. If you're not using it, I invite you to look at it. It's a very strong tool in our self-storage toolbox. Creating Wealth Through Self-Storage.com, Storage World Analyzer, or StorageWorldAnalyzer.com. Thank you very much, and I look forward to being with you again soon.